Start the proceedings today. We have been discussing with you under your syllabus several topics we have been discussing with you. Basically, we are discussing before we come to pricing. The pricing part, of course, we can move in financial markets. Financial markets. Under financial markets, we are discussing this one. Also, basically, money market, capital markets, and equity markets we have discussed with you. Equity market we have touched only. We are basically on government security market, so hopefully we can finish it off today. Yeah, most of the things we have covered. Only thing we'll have just concentrate the other related areas of this particular money market subject. So the financial market basically, right? So of course we have learned treasury bill, which is a money market instrument. Shorter tenor, everything will go off within 1 year. Capital treasury bonds we have discussed. The features we have discussed with you all, and the shares also we have discussed a little. And how are going to invest in treasury bill, treasury bonds, how this mechanism is worked. Is it option based? Treasury bill, treasury bonds are option based. And recent developments also we have discussed with you. The cap rate which we have proposed, which have been maintaining by the government, the Central Bank of Sri Lanka has removed from the last week onwards. So due to this policy rate increase, and also the undersubscription of treasury bonds, treasury bill markets, to avoid this undersubscription by the primary dealers. So that was quite vital. Central Bank to lift this or remove this cap which they have been used sometimes for a long time. Actually, they have been using this cap rate, maximum yield rate. Now from last week they have removed. If you can see this is the latest treasury bond option after removing this. You can see this, right? This is the latest press release issued by the Central Bank of Sri Lanka after removing the cap rate. 650 was the maximum. Now no cap rate, so any primary dealer, 10 primary dealers can put whatever the bids and the amount of bids at their own yield, but it can't be market away rates. Now see, last week 6.12, then you can't put 8%. That is unrealistic. But 657 is fairly okay. But the government has taken until 650. But see, now one purpose was to remove this cap rate to have more subscription. Now 38.5 billion needed, 55.4 billion received, but only accepted 20 billion. So we have discussed why, right? So the primary dealers have put their bids more than the requirement, but they wanted to have higher yield. So the government is not willing to take at higher yield. So that is government cost or the central bank cost. So they 16.5 requirement, but they satisfied with 230 million 1 year. So altogether they have taken more from 3 months, 6.38. Now 3 months is every 3 or after 3 months time, this maturity will be repriced. So if the interest rate comes down at that time, after 3 months time, then the government has the opportunity to reprice at a lower rate. So if you take it now, say somebody has put 7%, and if the government takes it at 7%, during this 1 year period, even if the interest rate comes down, no use. Government can't reprice it. Hataganama, you will have to pay it until it gets matured. But But the why they have taken more from 3 months is they have the opportunity to reprice. Government thinks interest rate will little come down in 3 months time. That's the intention they have. That's why they have taken more. That's why they have not taken higher amount of required amount of 1 year. Right. So those are the, you can interpret in many ways. You can interpret it many ways. But ultimately they have not taken whatever the required amount. So balance will be what? Money printing. So that still we can see some money printing is happening. So these are the government expenditure requirements, but only they have accepted 20. Right. If you have more tax revenue, then you can satisfy with this tax revenue. But since we have lack of tax revenue, balance has to be printed. Right. That is for information. And we are here, and we have been discussing with you some government security related to government security, the calculation. And remember that where we stopped, we have been discussing pricing of treasury bills. That is quite straightforward. This is quite straightforward. We have done this. So always remember that, just to recap what we have done last week, has to be anyway below 100, right? So unit price is 100. The treasury bills are discounted. The interest is paid up front, right? How do you invest in treasury bill? There are 10 primary dealers. You can go to them and ask from them. You can buy from them, right? So you'll have to buy whatever the yield they say. But is there any opportunity for you to take whatever the you think price or you think yield? Yes, if you have more than 5 million rupees, then you have the opportunity to participate in the auction through primary dealer. Right? Those are the things we discussed, and also we have discussed this relationship with you, price and yield relationship. When the yield goes up, price should come down. So it's a negative relationship we have seen, right? The relationship is negative. Price and the yield negative relationship is negative, and also the now this negative relationship is important. People who are maintaining government security portfolio in their portfolio, in their asset class. Now you know there are a lot of institutions in Sri Lanka are maintaining government security portfolio in their portfolio. Why? If you have anything you have invested in government securities or treasury bonds, you can treat them as a liquid asset. You know, in banks, the people who are working in banks, they know they'll have to maintain the 20% liquid asset ratio, and also they'll have to maintain 100% LCR. Uh, what is that LCR? Liquidity coverage ratio. And so both things are important for you to maintain, or for you to maintain government security portfolio to satisfy with this prescribed norm by the Central Bank of Sri Lanka, right? And so those investments can be treated as liquid assets, right? Not necessarily be in cash forms, but you can take into liquid asset calculation when you have investment. But only thing, or whatever the amount you have, now we discuss, remember that in the first lectures, the first discussion we discussed, when your bank needs to borrow from central bank, you have to keep security there. Remember that we discussed. So that is one purpose, that is one motive, one of the motives you're maintaining government security portfolio in your bank. Why? If you want to borrow from central bank window at 6%, right? So what are the two methods available for you to borrow? If you have short of rupees, first you can go to one of the other sister banks or the friendly banks. Or you can ask them, if you have excess, would you like to lend to me? Right? If they lend, you can have it. That is interbank market. If the other banks don't have rupee excess, so as a final destination, you can go to Central Bank of Sri Lanka window. We call it the repo window or the SLF window. There you will have to borrow at the rate of 6% now with the increase of policy rate. 6% for you to borrow, you have to keep a security. Security means treasury bill and treasury bonds. So then it is important for you to maintain treasury bill, treasury bond portfolio for the borrowing purpose as well. But if you calculate the liquid asset ratio, you have to deduct whatever the amount you borrow by keeping security, by keeping government security as it, by keeping the uh, by keeping by you when you're borrowing from the Central Bank of Sri Lanka under SLF window, you have to set aside securities for them. You allocate securities. It's a securitized borrowing. So then, if you have a government security portfolio this side, you have a borrowing this side. So then, when you calculate the liquid asset ratio, you have to take it the net balance. Take it the net balance. So meaning, if you have 100 billion government security portfolio, if you have borrowed 75 billion, you can take it 25 only for the calculation of liquid asset ratio. So whatever the amount you maintain, you keep it in your assets, but you have to deduct the borrowings you have made against government security. So you have to deduct it and balance only you have to take it as, you have to treat as liquid assets. So that is also important to keep in mind, right? So when your bank calculates the liquid asset ratio, so every month, the bank has to maintain that 20%. Otherwise, you will be, it's a breach, right? So quarterly, every quarter you have to maintain that. That is a compulsory, but every month you have to maintain. Otherwise, bank operation department will monitor you, and they will charge you. Right? They will. It's basically non-compliance. It's very important, right? So we discussed the market liquidity present, the minus. So almost all the banks are having rupee liquidity minus due to this SRR increase or something. So the people don't like, the investors don't like, people are holding government securities don't like interest rate to go up. Why? When interest rate goes up, obviously government security rates also going up. So then what happens to the price? Come down. So that every month your government security portfolio has to bring it to current market rates. So remember that now there are three categories you can put it the government securities. One thing is trading. There are two types of trading. Available for sale, you know these things. Held for trading. What's the other one? Held to maturity. So the held to maturity portfolio you don't revalue. So if you put anything into held to maturity, you can't sell it. Then you have to keep it until it gets matured. Say you have purchased treasury bond or 5-year treasury bond. Now today, you can't sell it. If you categorize it under held to maturity, then you can't sell it. You can't sell it. You have to hold it until it gets matured. But only thing you can sell which are available in AFS, available for sale, and held for trading. So these two categories has to be revalued every month. You have to bring into the today's valuation based on the today's value. So if the rate goes up, obviously price come down, then you will have a asset reduction. Asset reduction. So then it's a charge to your P&L. You had last month 100, now you have to bring it down 75. So the 25 has to be charged to P&L. So it's an additional provision for you to make. So the people don't like you can't sell it. If you sell it you will be selling at a loss only. So important relationship you are. And somebody was asking last week what's the relationship between coupon rate and the yield? Same relationship, right? The coupon rate and the yield. Now, yield and the coupon rates, it is two different things or same thing? It's two different. Yield is different, coupon is different. So what's the difference? Now, say now there is a treasury bond, 10%, 5-year treasury bond. Somebody is having this, but you need to purchase this. You like to invest in this particular treasury bond. What do you make treasury bond? So then 10% coupon. You need to buy this. For you to buy, there should be a price. There should be a price for you to buy. That is yield. But only thing in Sri Lanka, we are not talking about rupee terms. We are not talking about rupee terms. Basically, we talks about in terms of percentage. If you want to buy, somebody has to sell it. If he likes to sell at 8%, that is your price. Now, how do you decide? Now, how do you decide this seller is making profit or loss? It depends on how much, what price, or what yield he has invested earlier. Now you have purchased this particular, you have investment, or you made an investment in this particular one at 8%. Now you are having it today. So what are the features available? 10% coupon. It won't change. 10% coupon, it won't change. Whoever who buys before it gets matured, coupon won't be changed. Coupon is definitely, it is the coupon 10% now, 10% more. You can't change it. 5 year, it can change. Why? After 1 year, remaining maturity period is 4 years. Now it's a 4-year bond. That can be changed. But coupon can't be changed. Semi-annual coupon can't be changed. Why? Treasury bond, government treasury bond. Government treasury bonds, always semi-annual coupon. So then, what is this 8%? That is the price. Now see, now I'm using the word price, but actually it's a percentage. That is the price you have purchased. That is the price you have invested. That is the yield your money has been invested. That's a confusion we have. So then, how can you say that? I just asked you to discuss. Now this is available in your books. 10% coupon. Remaining maturity 5 year. 5 year. I have 5 year TD. 5 year. Your money has been invested at 8%. Now see, two different things. Coupon is 10. Yield is 8. What is the yield? Yield is the percentage your money, the purchaser's money or the investor's money is invested. So then how do you decide, is it worthwhile for me to invest my money at 8%? That is up to you. I have 100 rupees with me. Mama කැමති නම් මේක 8% වලට මේ 100 රුපියල් invest කරන්න. That is up to you. And so somebody is saying, no, I don't want to invest in this treasury bond. I have any other, I have alternative investment in to make the investment at 10%. Then you have to take a decision. Are you satisfied with 8% return or are you satisfied with 10% return? That is up to you. Obviously, you go for what? 10%, but it depends. It depends. So what are the dependencies? Now this 10% gives you, if you make an investment in a finance company. Now see, here the government investment. Which one you select? That is up to you. Somebody will say, no, I'm very much sure that this finance company will pay back. So I will go. Why? They are paying 10% yield. That's good for me. So I will pay there. I will invest my money there. That is up to you. So somebody will say, no, I'm not sure. They are rating also down. They have a not good rating. So I'm not worrying about 2% increase. By 8%, 10%, I'm not worrying about the yield. I need my money back. So I will be satisfied with government investment at 8%, even at a lower rate. So that is up to you. Different people, different intentions. So can't say exactly what is their intention. Right? But when you are a rational investor, you will have to think about many things. Yield is one only. Yield is only one criteria. So you will be receiving interest on the until it gets matured. But what happens if you don't get the principal back? What's the principal we call it? Face value back. If the company does not pay you the face value back to you, so then you disaster. If the 5-year treasure, if the 5-year debenture, this guy 5-year deposit killer him. Now before 5 years, company collapse, bankrupt, you won't get anything. So the government is not like that, even at a lower yield. So that's why highly rated banks, highly rated finance companies, highly rated institution, if they issue any instrument, the interest yields are lower. If your ratings are not that good, you have to pay more to attract new customers, to attract new investors. That's obvious, right? If I am making a now treasury bill and the bond, now see the difference. Now see the issue is the same. Treasury bill issue is the same. Treasury bond issue is the same. Government, central bank, but two different rates. Why? 1 year treasury bill I showed little while ago I showed it to you. 650. What is the 5-year treasury bond going at? It's 970. Now 970. So what is this difference? Issue is the same. No risk. No risk in the sense the default risk is not there. Counterpart risk is not there. Credit risk is not there. Other risks are there, right? So what's the difference? 650 and 950. What is this difference? What is this difference? 3%. Why you want to pay more? Why the government needs to pay more? Why the government needs to pay more to attract new customers, new investors? Only the tenor. Tenor is the only different. Period is the only different. Why? Can't predict 5 years from now. But can you predict 1 year? That's how we think. We can think what will happen in 1 year's time than what will happen in 5 years. Obviously, right? Shorter the better. Shorter the better. So basically, when you have a more period investments, when you have a lengthy investments over the period of time, then you have to pay over the issuer has to pay more. What is the difference between 650 and 950? Same thing, but that is the maturity premium, not the risk premium. Remember that, right? Now this treasury bill, if you take this 650, this rate has been comprised two things. It's not available here, but for your knowledge, I will tell you. Real interest rate plus inflation. The meaning is 650 is after adjusting the inflation. After adjusting the inflation. What's the inflation now? It's 6.08, right? Slightly 1 pip compared to July. CCPI has come down 0.1 compared to previous month. There is a reduction, but we say it's a 6% weekend. Big figure is 6%. We say 6%. Now, if the 1 year treasury bill rates are going at below 6, meaning is you are virtually lost. So now it's 650. So at least you have 0.5%. Now this 650 is after adjusting the inflation. So what is this 3% then? So if you take treasury bond rate 970 or whatever the treasury bond rate, 5-year treasury bond, we say 970. It comprises three things. What are three things? Basically two things: treasury bill rate plus maturity premium. So treasury bill rates, what are the components? You have real interest rate plus inflation. Then treasury bond rates comprises real interest rate plus inflation plus maturity premium. So when you have a longer tenor, you have to pay little premium. You have to pay little premium, even from the government. Government is basically risk-free, but still you have to pay this. So why do you want to pay more? Why do you want to pay maturity premium? Now see, so then basically you are deprived investment. Now if I put 5 years, if I put my money for 5 years, so what are the things I will deprive? Basically what I can't do, what are the things? Now say after 1 year there will be a rate hike. Can I invest? I can't. Why? My money has been locked for 5 years. True that if you want, you can break it and you can pre-sale, you can premature and you can do it. But forget about that. That is extreme cases. But then my money is blocked. I can't take this decision. I can't reinvest. So the reinvestment risk is there. Interest rate risk is there. Liquidity risk is there. Right? Why? You can sell it, but if you are a seller, you need to make profit. You can realize your money. That's the feature of a treasury bill. You can anytime you can sell it, but it doesn't say that you can always sell at profit. You can sell it at profit depending on the rates and the yield, or the price and the yield, depending on the market yield only. So significant losses you can make it. There's a liquidity risk. So all these other risks are there. So all these other risks, okay, government, even we invest with you, government, you have to pay something for us. Why? We are depriving our different privileges. Like risks, I told you. Risk are what? Risk are basically your expect deviation, your expectation. Now, when we discuss portfolio management, we'll be discussing. So the risk is what? Deviation from the expectation. Deviation from the expectation. So then you pay something more. You pay something more. That's why government is, so any instrument, not the government, but I have taken government treasury bills are risk free. And their instruments are risk free, but still you have to pay for the longer tenor. So if the tenor is long, pay something more. Why? Future is quite uncertain. Now, I don't know whether you can remember. Uh, uh, Now, government banks, they can't issue debentures. They can, but only thing, if you want to take your debentures into the capital, they can't issue debentures. Normal debentures they can't issue. They can't issue normal debentures. So they'll have to issue what kind of debentures then? Convertible debentures they'll have to issue. Convertible debentures only they'll have to issue. Now, for you to issue convertible debentures, now see this one. Now convertible bonds or debenture bonds same. Now, if you want to issue convertible debentures, then only you can take into account. Now, if you see the recently closed commercial bank debenture, the Basel 3 compliant debenture. I'll read it to you. This one. Now see, Commercial Bank of Ceylon PLC announces the opening of its Basel 3 compliant debenture issue to raise up to Sri Lanka rupees 5 billion with an option to 5 billion. Right. So basically now see, now they say through debenture option to up to 500 million individual investors. Now minimum subscription is for qualified investors 10%, 10,000. Now this qualified investor, now everybody can't invest. So the only qualified investors can be invest. Now when you issue a debenture now, convertible debentures, so the Basel 3 compliant debentures, everybody can't invest. So the qualified investors only can be invest. Now if you see, if it is a the what you call private placement, this is a public issue. Private placement, 50 million is the minimum investment. So for you to become a qualified investor, you should have 50 million to invest. So those are the things. Those are the things actually available in normal debentures. Why? Why? Now there is a risk of investing these kind of debentures. What's the risk? Convertible is what? So one day before it's get matured, whatever the debenture amount can be converted into shares. Who has the right? That's the point. Who has the right? Now see, read it this one carefully. Convertible bonds or the debenture. Holder has the right to convert. Convertible debenture. Holder has the right to convert. The holder means what? Person who is invest. Person who is invest has the right to convert. Now, who can say when he is going to convert into shares? Nobody knows. Nobody knows. So there is a risk of time. Exact time is a risk. So then you pay more. Now, if you see similar, now these kind of debentures or bonds cannot be issued by the state banks, right? They don't have shareholders. They have only one shareholder, which is the government. So you can't issue shares. So then, so there is an instrument for them to issue, that is additional tier one instrument. So that bond or that debenture is perpetual. Have you heard before? Perpetual. There is no maturity. There is no maturity. After 100 years, no maturity. 200, no maturity. Basically, if you invest in this particular instrument, no maturity. No maturity. Can you imagine that your money will be investing? Your money will be investing the instrument like this, which is no maturity. Only the coupon or whatever income you'll be receiving until you live. So after that, you can transfer it to somebody, but no maturity. Then it's up to you to decide whether you will be making investments or not. Why? We can't convert into shares. So then what happens? If the bank collapses, your investment is written off. So those are the features available in this. You want to take into capital, you want to raise. Now government banks, basically who should be funded? Government has to give capital. If the government does not give capital, they'll have to find out capital in many methods. But capital, if you say capital is what? The amount owners put. If you have one owner, does it become a capital? No, that is not capital. Capital කියලා කියන්නේ අයිතිකාරය දාන සල්ලි වලට හරි whatever. අයිතිකාරය දාන්න ඕනේ. අයිතිකාරය එක්කෙනයි නම් ඉන්නේ. අයිතිකාරය දාන්නේ නැත්නම් if somebody puts, can you call that capital? No, you can't. So there is no capital then. But for you to find out the capital, there is a method given. What is the method given? You issue a debenture and take money from the qualified investors. We will allow you, central bank will say, okay, we will allow you to take whatever the debenture portion into capital, but the debenture has this kind of feature. Perpetual, callable option has to be there, new word comes, callable option, and if the trigger point, whatever, if the bank collapses, you will have to write it off. Now it's very difficult to find investors this kind of instruments, right? And what do you mean by callable option? Now read the second one, the callable option. Now who has the right to call? You have invested in your money in an instrument which has callable option. Now see, issuer has the right to redeem. Issuer. So the ABC Bank issue a perpetual debenture. You have invested. So who has the right? Who has the right to call it? Issuer has the right. Issuer means what? ABC Bank. ABC Bank को क्या ना? काला 11 पास से मैं डिबेंचर का भी कैंसिल करना. We will pay you back. So you, as a poor investor, you say no. I don't money now. I want to continue this. No. We have taken a decision. Why? Callable option is with us, so we will redeem it. So who will be the victim? Investor will be the victim. You're expecting at least more cash flows. Intention is to hold it. There is no maturity. You knew it at the outset of the investment. You knew it. There is no maturity, but I am satisfied with the return I am getting. කමක් නැහැ මට perpetual. I know that. But return එකෙන් මට ඒක compensate කරන්න පුළුවන්. So I don't mind, I'm invested. But suddenly the issuer says, no, we are not continuing with this. We will execute the callable option. Generally, remember for your knowledge, this kind of investment has 5-year callable option. So after 5 years only, issuer can call. Until it completes 5 years, you can't. Now sometimes you might think, this is good. Yes, this is sometimes good. Now, කෙනෙක් ඉන්වෙස්ට් කරාට හිතේ හයියට perpetual bond එකකට කෙනෙකුට හිතෙන්න පුළුවන් අපරාධ මම මේක ඉන්වෙස්ට් කරේ කියලා. right? අපරාධ මේක ඉන්වෙස්ට් කරේ මට මේක අවුරුදු 5ක bond එකකට දැම්ම නම් I would have get the redemption, I would have get the face value back. So sometimes some investor might think about it. So then central bank has given the option. Okay, don't worry. After 5 years, we have given the opportunity to issuer to recall or the redeem. Then you decide whether you need to continue or whether you need to get it back your money. So the investor is not penalized at that time. But remember, that option is with the issuer. That option is with the issuer. If the issuer thinks, no, we will not call. We will not execute the callable option. Can somebody say, why issuer thinks at that time not to execute callable option? Now forget about the AT1 instrument. AT1 කියන්නේ additional tier 1 instrument which is allow government banks to issue debentures, kind of debentures to take into Basel III capital deposit ratio. But forget about the AT1 instrument. Now there is a debenture. You issue a debenture, your bank issue a debenture with the option of callable option. Today you issue a debenture, 5-year debenture at 9%, 5 years. Now today you issue with the callable option. Now what happens? Callable option, if you have a callable option, before it gets matured, issuer has the right. Who's the right? Who has the right? Issuer means who? Bank has the right to recall. Can somebody say, why? Now say there is a one occasion this bank does not execute this callable option. And there is another bank, they executed this option. Now, can somebody say, if there is a bank with a callable option bonds, if they execute this callable option, what kind of scenario, what kind of situation they have faced to execute this callable option? ඇයි මේ callable option එක මේ බැංකුව execute කරේ කියලා can somebody say? Bank is issuing a debenture at 9% for 5 years. After 3 years, bank decided to execute this callable option. Why? The question is why? Can somebody say why this bank has executed this callable option? Now this callable option is common. Convertible option is common now. Right? Now, depending on the interest rate, the bank has to take a decision. You issue a debenture at 9% for 5 years, meaning what? අවුරුදු 5ක් යනකම් 9% ගන්න you have to pay. Think from the, I'm talking about the issuer side, right? අවුරුදු 5ක් යනකම් 9% ගන්න you have to pay. හැබැයි 3 years ගියාට පස්සේ bank එක decide කරනවා නෑ. They will not continue this balance 2 years. They will recall this. Why? Can you do that? Yes. How? Callable option is there. Okay, good. So issuer, bank decided to execute this. Bank says we will pay you. Investors are like, no, we will pay you whatever the amount you have invested. We will pay you. We want to close this debenture. and we need to settle it. Why the bank has taken this decision? Now, issued at 9%. Now think, after 3 years' time, interest rates have come down to 6%. Meaning is what? Even the market interest rates have come down to 6%. Can you do that? Can you, if it is a normal debenture, can you settle it? You. The bank would have issue their debentures even at a lower interest rate, they can't recall it. Why? If they don't have callable option, then they can't do that. But remember, if the callable option is available in a particular instrument, you have to pay more. Why? Investors know what investors know. Basically, investors doesn't know what time the bank will recall this. Then you pay more. So we can't be the victim. Hurry up, victim win now, but you have to pay more. Now, when the interest rates have come down to 6%, whereas you have to pay another 2 years, 9%. පහකට issue කළා අවුරුදු 3ක් යනකොට interest rate එක 6% වලට වැටුණා. Since you have binded this debenture, you will have to continue with this 2 years. Why? Debenture is 5%. Debenture is 5 years. So basically, you have to continue with this paying 9% interest for 5 years. But callable option is available. So then, so the bank says, why should I say at 9% for another 2 years? No need to pay. No need to pay. Then they execute this callable option. And by executing this callable option, they can issue debenture at 6%. So that's the beauty of that. But it is good for the issuer, but it's bad for the investor. It is bad for the investor. So this feature is available in the 81 instrument. So that is one thing important for you to note. Now, if you see this commercial bank recently issued debenture, qualified investors are eligible. Not all investors can be allowed to invest in this particular instrument, right? So remember that. Now earlier the banks issued subordinate debentures. Now the banks issued convertible debentures. Convertible debenture means what? You can convert into shares at a particular one day before it gets matured. So if you take private banks, that is, you will be converting into shares. So if you invest in debenture, you as the investor, lender, you get what? Coupon interest. But if you become you decided to convert into your debenture into shares, you become a shareholder. Now see the completely different your mode. So the lender becomes a shareholder. So once you become a shareholder, are you getting interest? Coupon interest? No. You are getting what? Dividend. Now see, completely changed. Your role is completely changed when you issue a debenture, convertible debenture, and issuer execute this. There is opportunity to convert by the issuer. So we were talking about interest rate and yield and the price. So the negative relationship, and anybody says the relationship between inflation and the interest rate. Do you see any relationship between inflation and interest rate? Of course. When the inflation goes up, interest rate has to go up. Why? You have to compensate whatever the inflation against this yield or against this whatever the percentage in the RO, return on investment. So basically, expecting if the fundamentals are working properly, when the interest rate goes up, obviously yield rate has to go up. So that's why the government has decided to. That is one reason. That is why government has decided to get rid of this maximum yield price. So no point of value. Right? So So you basically now after lifting the first option is also undersubscribed. Right. So any question you have so far?
Yes, so just I want to know about just what we discussed about the convertible bonds, like the convertible debentures or something like that. So, in what instances that bank convert these debentures or bonds to the shares?
No, I didn't get it. What is your question?
Yeah, that's what we discussed about the convertible debentures or convertible bonds that the private banks normally they are issuing. What you said. So, in what instances that bank convert these debentures into the shares?
So basically, when you are issuing Basel III compliant debentures, so there is a trigger point now, right? So when now here the convertible debentures issuing means the issuer has the right. I'm sorry, the investor has the right to convert, but investor can't. This investor can't say that I need to convert this my debenture into after 1 year. No, you can't. After 2 years, no, you can't. There are some instances. There are some instances approved by the Central Bank of Sri Lanka. Okay, this happens only you are eligible to convert. This happens only you are eligible to convert. So one thing, it depends on your bank, issuer bank. Now why these debentures are issuing? Obviously, they'll have to take this debenture amount to the capital. So why do you want to take into capital? To maintain required capital adequacy ratio. So the one trigger point is that if the bank does not meet the required capital adequacy ratio prescribed by the Central Bank of Sri Lanka, that is one of the trigger points. That is one of the trigger points, right? Now there are trigger points prescribed by the Central Bank of Sri Lanka. Now say if you are breaching the 2-3 norms prescribed by the Central Bank of Sri Lanka, so the Central Bank says, okay, you have breached this. So this is one of the trigger points. So you inform your investors, then you'll have to. Then basically investors has the right to convert like that. So trigger points are available. Bank to bank is different to different, and it is basically prescribed by the Central Bank of Sri Lanka. It is not unique. That's what I want to tell you. It is not unique. It's different from bank to bank. So it is up to the bank to decide when they issuing a debenture. It's available on the prospectus. What are the trigger points? So the investor has to give all the information. It's available on the prospectus. Why? This is the IPO. Now this commercial bank is you are inviting public to invest. So the public are invited through what? Prospectus. You have to print prospectus. So the prospectus is available all the information which is relevant to the investment decision. So the trigger points also should be available in there. But it can be changed. It has to be different criteria to the different banks. But I'm 100% sure since you are taking this particular amount of capital, if you don't reach the capital adequacy ratio, that is one of the trigger points. That's for sure.
Yeah, that means the bank is not performing up to the standard, but the requirements, everything under the central bank requirements. That's the mean that they allow to convert this. I mean,
only thing, my sound may be not clear. It's raining heavily. I couldn't hear your question. What is the question? Can you repeat it a little loudly?
Yes, actually, the Central Bank of Sri Lanka has given that instruction to that particular instances in order to, I mean, the bank is not performing up to the standard, but they need to maintain the tier 1 capital adequacy, and that's the thing that they instruct to the shareholders. I mean, there is the debenture holders to convert this the shares.
Can you repeat last part of your question?
So, if the bank is not performing up to the standard, the central bank instructed to this, I mean, that is, convert this from debentures to shares.
Yeah. Now, basically, not performing in the sense now say, as I told you, now all these Basel III requirement ratios have to be complied every month. Every month, this has to be there. And if you know your bank's financial results are published every quarter outside, but central bank is watching you every month. So you'll have to comply with every month these capital adequacy ratios. Now all these other now liquidity ratio, capital adequacy ratio, leverage ratio, liquidity coverage ratio, and NSFR. All these ratios have to be maintained monthly to the norm. But publicly available informations are available every quarter. Why? Your bank is supposed to publish your financials every quarter, but every month your bank has to maintain this. That is a compulsory. So meaning, if you don't comply, meaning you are breaching. I don't know whether I have answered your question.
Yes, clear, sir. It's clear.
Any question anybody has?
So last, I think before the connection was, we discussed the characteristics about debentures.
Yeah, anything I could answer anybody's question?
So actually, sir,
your question, you said, what was the question? Can you repeat?
As per the slides which you have given us, certain characteristics are given under bonds, which are similar to the characteristics under debentures. So my question is that these characteristics are same for both the securities, bonds and debentures?
Yeah. Now, if you take debenture and treasury bonds, characteristics are almost similar. But there are a few differences also. Now, for example, as I told you, issuer is different. Now, debentures are generally issued not by the government, but for the private companies or the private institutions. When you say when the private company is issuing debentures, we call it sometimes corporate bonds. Corporate bonds and debentures are very much similar. There is no difference. Only the name is different. But compared to treasury bond and the debenture, there are differences. First difference is the issuer. Issuer is treasury bonds. If it is treasury bonds, so always government of Sri Lanka or the Central Bank of Sri Lanka. So basically, Central Bank of Sri Lanka on behalf of the government. And another difference is treasury bond is always their coupon is semi-annual. It has to be semi-annual anyway. No, there can't be anything other than that semi-annual. So treasury bonds, coupon interest payment has to be semi-annual, but debentures it can be monthly, it can be semi-annual, it can be quarterly, it can be annual, anything like that. Now, for example, now this recently issued debenture of commercial bank, their interest payment is I'll read it to you. Their interest payment is semi-annual. Now the interest payment is semi-annual. So the both now they have type A, type 2, 5-year, 950, and type B 7 years. That is also type A 5 years 9%, and type B 7 years 950. So see, now when the tenor goes up, when the tenor is extended, now 5-year 9, 7-year 950. Obviously, you carrying a risk as an investor. And interest payment frequencies both are semi-annual. So sometimes you can see some debentures are paid annual as well. It depends. Now basically, when you have this kind of situation, you should now say you have separate different interest payment scenarios: annual, semi-annual, monthly, quarterly. So how do you decide it? So basically, when you have a fixed deposit, you have to publish the AER, annual effective rate. So basically, if you have to take a decision based on the AER only, not by the nominal rate. Now say somebody might say, now if it is now say 1 year 950, semi-annual 9%. So you are thinking that okay, 950 is more than that, but semi-annual 950, which one is better? But don't worry, you bring everything into one platform, which is AER. You know this, right? Based on the AER only you take decision. AER means what? Annually how much you're paying. Annually, how much you are getting, or annually how much you are paying. So basically, based on the AER only, you take decision on the investments.
Okay, thank you, sir.
Any question anybody has? Now we have completed this. See these now. See these are the interest other risks I was referring to. Only the default risk is not there. Other risks are there. And if you see this particular note, I have completed everything. I think this is okay. Just to read the features you said. There, this has been calculated. Straightforward calculation. Only thing you have to keep in mind, the remaining maturity period has to be taken, right? And this one also, I just want to tell you, this is also live thing. Now, if you say 1 year will, now this is how it code. Now, basically, it's basically codes are coding in terms of percentages, not by the pricing, not by the LKR pricing, but it goes as percentage. Now, say like we discussed, you know now how much now there is a bond or there is a treasury bill. What is the price you are selling at? Basically we tell or we refer it in terms of percentages, right? Percentages always. Now then hypothetically you have to convert these percentages into pricing. So then you can read it. Now exact pricing, we know if it is a treasury bill, how to find out. So we will be learning now how to find out the exact pricing in terms of treasury bonds, right? We will do it. Only thing now, when you want to, somebody is asking whether are you selling common securities, it has to be less than the purchase yield. That you have to keep in mind. I'm just telling you the essence of what we have learned so far, right? Somebody is asking, are you selling this bond without calculating the pricing? By looking at the purchase yield and the present yield, you can decide whether I am selling at a profit or loss. Now, this premium we have discussed, anything above 100 premium, anything below discount. Face value also we discussed on the maturity, we are getting face value, and also remember the difference between coupon and the yield. Two different things, right? Two different things. I discussed that as well. Then coupon, everything is okay, fine. And these features, convertible bonds, feature discussed, callable bond, who has the right? That's the important thing. Putable bond, that's another term I want to tell you. And junk bond is basically, now you must have heard this of Sri Lanka ISB. International sovereign bonds are under junk category. So anybody who pays more, the higher yield, we call it junk category. Why you want to pay more? Now you know. Ratings are downgraded. So basically, when a country's ratings are downgraded, the country needs to have more, then you pay more. That's the normal thing, right? We have done. This is done. Features, advertisement we discussed. This table we discussed. This is also important. Other relationship we need to discuss, but we know. You know the background. Coupon and the yield, same thing which we discussed, right? And also remember the other risks. Default risk is not there in terms of common security, which we discussed. Other risk. Now here the liquidity risk is also there, right? Liquidity risk, it is not available in your notes. So liquidity risk is also there. And this one is also another factor. Intrinsic value. These are the terms, right? Intrinsic value means the true value. When you calculate now, the next item is you are calculating treasury bond, the pricing. So basically, this gives the true price, true value. So anybody who likes to purchase this particular instrument, if this criteria are satisfied, So then what is the pricing? Now, for example, now see this one. Now, this is the type of this one. Now, see. Now, consider 4-year debenture. Now, debenture treasury bond, right? Which one is? Consider 4-year debenture with a par value of 100, which pays a 16% coupon annually. Now, here, coupon is paid annually. An investor who is considering the purchase of this particular debenture requires a rate of return 20. Now, see, there is a debenture, remaining maturity period is 4 years. Remember, if somebody gives you original maturity, wherever you see, don't worry about the original maturity. Where we need the remaining. Here, the remaining maturity and original maturity is same. We have not given the original. So 4-year debenture, par value is that we know 100 in Sri Lanka. 16% coupon that we know. Coupon. What is the coupon? We have heard. How does it pay? Annually. Investor who is considering to purchase this debenture requires a rate of return 20. Now see, if I want to invest in this debenture, I need at least for me to invest 20% return. That's what it means. So to satisfy everything, how much should I, what is the price should I purchase this bond? That's all. That's the question. To satisfy 4 years, make a mature now. අවුරුද්ද ගානේ 100,000 මට හම්බත් වෙනවා. මම ඉන්වෙස්ට් කරන සල්ලි වල කවුරු හරි කෙනෙක් ඇහුවොත් ඔයා මේ බොන්ඩ් එකේ ඉන්වෙස්ට් කරලා what is your yield? It has to be 20%. Now you know why 20%, why 16%. So the coupon and different from yield. Correct? That we know. කවුරු හරි කැමති නම් මට මේවට මගේ ළඟ තියෙනවා 4-year debenture එකක් 16% coupon ගෙවන එකක් තියෙනවා. අනිත් ඒ මොකද වෙන්න ඕනේ? කෙනෙක් ඉන්නවා ගන්න 120ට. මම කැමති නම් මේක 120ට දෙන්න යාට. He will buy it. මම කැමති නම් 120ට දෙන්න means what? If I want to sell this particular instrument or the debenture at 20%, plus I need to make a profit. Otherwise, I don't make investment. Now see, before it gets matured, I'm going to sell it. Somebody is there to purchase. Now this guy. Now this investor. An investor who is considering to purchase. Okay, there is the investor there. Now I have this particular bond. Now what is your price? What is this investor's pricing? 20%. If I have this bond, I have this particular debenture. Now, only question is whether will I sell this particular instrument at 20%? If I want to make up 20%, if I want to make a profit by selling this particular debenture at 20%, can somebody tell me what price should I have purchased this bond, purchase this particular debenture? Is it more than 20%? No, less than 20%. I make it easy for you all. If I want to sell this particular one, think from the seller. Now you are the seller. Somebody is there to purchase. 20%. He needs to. Now, why we are talking about the selling price in terms of percentages? That we know. In Sri Lanka, it is so. Right? Now, somebody is there to purchase this particular instrument at 20%. If you have this particular instrument, so you like to sell this particular instrument at 20%, meaning is what? You have purchased this particular debenture. You have invested previously in this particular debenture at more than 20%, no, less than 20%. You will be selling any debenture, any treasury bill, any treasury bond below the purchase price. Are you making profit or loss? Below the purchase yield, are you making profit or loss? You are making profit. Why? Now, if somebody needs to sell this particular bond 20%, say, now I should have purchased this particular, or I should have invested my money in this particular instrument more than 22, more than 21. Now, say for example, Hari, Mamme Bondege, I have purchased this particular bond 1 year ago, 2 years ago, 3 years ago. It doesn't matter the time. Here, the most important thing is yield. Based on the yield only we decide, irrespective of the time, irrespective of the tenor, irrespective of the remaining maturity period, irrespective of the coupon. We take only one criteria, which is purchase yield. Now, say I have purchased this particular bond or the debenture at 22% 2 years ago or 1 year ago. Now somebody is asking at 20%. Am I selling or not? If I want to make a profit, of course. Why? 22 වලට ගත්ත එක 20% වලට. Interest rate or the yield has come down. So the price should go up. 22 වලට ගන්නකොට hypothetically I am thinking, I would have 898. Example. This is how you think. 22% වලට මම ගත්තේ. 22% වලට ගත්තාම when you calculate it, you don't have to calculate. Hypothetically මම හිතනවා මේක අරයින් 90යි. 90ට තමයි මම ගත්තේ. Now he's asking 20%. Rate has come down. 22 to 20. Rate has come down. Yield has come down. So then, when the yield has come down, price should go up. Up means what? I have purchased this particular bond at debenture at 90. Then yield has come down. Price should go up more than 90. It has to be more than 90. So the 90 all are you selling at 92? Of course. Are you selling at 91? Oh, why? How do you decide it? You are selling this particular instrument at less than the purchase rate. Anything you sell at less than the purchase rate, you are comfortably making profit. Now, don't get confused, right? Why? Now, if somebody asks, are you making profit? Obviously, you can think common sense. We have 2 rupees gain. But in this case, I'm again telling you, in Sri Lanka, with regard to government securities, we go by the percentages. So when you say percentages, how do you decide? If it is more than purchase yield එකට වඩා අඩුවෙන් නම් කවුරු හරි ඉල්ලන්නේ ඔයාලා විකුණනවා නම් purchase yield එකට වඩා අඩුවෙන් විකුණනවා නම් then you make profit. Why? The relationship we have just discussed, negative relationship. 22, now it's 20. Yield has come down. Price should go up. Okay. So we'll be learning, understood? So this is how it comes. This is how it comes. Intrinsic value means basically the true value. So when you calculate the pricing of a particular bond, when you calculate the pricing of a particular treasury bill, it gives a true value. So the market value may be different. Now say the earlier question, somebody was willing to purchase this particular debenture at 20%. මම කැමති 20% වලට මගේ සල්ලි ඉන්වෙස්ට් කරන්න. හැබැයි ඒක මාකට් ප්‍රයිස් වෙන්න ඕනේද? සමහර වෙලාවට මාකට් එක යන්නේ 20% වෙන්න පුළුවන්. නමුත් මාකට් එක යන්නේ ඊට වඩා අඩුවෙන් වෙන්න පුළුවන්. සමහර ඊට වඩා වැඩියෙන් වෙන්නත් පුළුවන්. I don't mind. Required rate of return, that is mine. So the intrinsic value is what? Intrinsic value is basically the true value. If the true value is more than the market value, true value is more than the market value. Now take example of shares. John Kill shares is trading at today 130 example. But if you calculate the John Kill's group, net asset value and whatever the pricing, the value per share is 150 example. Now the market is going at 130. True value. At the valuation, if you calculate 150, are you buying or not? Obviously you buy. Why? You have a potential to increase the value. Why? true value is 150. Today value is 130. So 20 value, 20 rupees, there is a valuation to go up. It depends. Sometimes it can go up to 150, sometimes it may not go up to 150, but true value, true value gives an indication for us, okay, there is a potential to go up. There is a potential value. There is a potential value to go up. So when you buy something, meaning is what? ඔයා සමා ඕන දෙයක් ගන්නේ, you have an intention, you can sell it at high. මොනවා හරි දෙයක් මම ගන්නේ, I think that I can sell this particular whatever the item at a higher price. මොනවා හරි මම දෙයක් ගන්නේ මට වැඩිපුර විකුණන්න පුළුවන් හින්දා. So basically what? The item is undervalued. So you should buy instruments which are undervalued. Then only you have potential to sell at a higher price. So meaning is what? Intrinsic value is true value is more than the market. Market එකේ මොන හරි වෙලා අඩුවෙන් ට්‍රේඩ් වෙන්නේ. Due to ප්‍රශ්න හින්දා due to various ප්‍රශ්න හින්දා market is going at a lower rate. But true value, there is a true value of this particular instrument. There should be one day this true value will reach. Okay, then I should buy now. Why I should buy? Undervalue. Why should I buy? Undervalue. Undervalue means what? There is a potential to go up. That's how you do. So basically, true value is more than the market value, then you buy. Buying meaning buying in short, you should buy undervalued shares, undervalued instrument, right? That is how you. So important relationship for you to understand, right? Now this warrants I'll come later when we're talking about later. Also I'll tell you now warrants are the sweeteners. Now basically warrants are the sweeteners in the sense now when you purchase shares. Now you ask to purchase John Kill shares, but John Kill's company gives a sweetener for you to buy, for you to encourage to buy. After 5 years time, I will give you another set of shares for you to sell. That's the sweetener. Basically, warrant is a sweetener for you to buy shares, but very rare. Now, warrants are also trading, right? In the share market, warrants also can be traded. सामान्य तो අවුරුදු 5ක් යනකොට මේ price එක they are actually giving you a discounted price. So thinking that this price would go up in the future, then you purchase today. Otherwise you won't purchase. But this is also another market instrument which is related to shares. Right now, debentures we have discussed. All features we have discussed very similar to this. Stocks, of course. Bonds are very similar, only the issue is different. Now this is for your information I have given you. Since the country is downgraded, this is how the ratings are going on. Now there should be a Fitch rating also. Fitch rating also the similar one, right? Now we are in CCC category here. Basically we are on the verge of default, right? So if we go beyond another notch, a disaster, right? So basically, we'll have to be very careful not to go beyond that, but to go above this. That's a disaster, right? So before we move into this, I'll come to this one. Since we have completed this particular question, these things for you to read, right? These things we have done this. Pricing, this we have done, this one, since we are actually on the completion of our one. Now see, only thing you have to keep in mind, this is how we calculate the treasury bond pricing, right? Consider, this is how it comes. Consider 4-year debenture or a treasury bond, whatever, with a par value of 100. 16% coupon annually, investor is expecting 20%. It's very simple, right? Understand carefully. Now, there is no formula for this. There is a formula, but only thing, it's a lengthy formula. Don't go by the formula, but understand the concept. Now, practically, we don't calculate treasury bond pricing manually. We don't use formulas to calculate. There is a particular calculator, we call it bond calculator. So you feed all this information, remaining maturity period, then the coupon interest and the frequency of coupon and the required rate of return. Basically, we call it discounting factor. Don't worry about it. Discounting factor is the same, which is very similar to return on investment. You expect this much. How much you expect here? By investing 20%. Finish. All this once you fill it, you get an answer. That is what the using bond calculator gives the answer. That's how it calculates. This is our question. This is the formula. It's very lengthy formula, and no use of difficult to understand. Right? Don't use this formula, but that is easy for us to calculate the treasury bond by using. But the base is this. Base is this, right? Now this is how you calculate. Now on basically, when you calculate the treasury bond, we calculate the treasury bond pricing based on the cash flows. Now see, listen to carefully. Listen carefully. Cash flows. So when you invest in this particular debenture, what are the cash flows we are getting? Coupon interest. Nothing else. Coupon. Whatever the price you invest, doesn't matter. Coupon is you are getting on the face value. Coupon is paid on the face value. Coupon is paid on the face value. Coupon is paid on the face value. Investment amount and the face value is two different things, of course. Can't be at same amount. Amount and vendor but two different concepts. How does the coupon is paid? How does the coupon pay? Coupon is paid on the face value. Now, how many coupons you are getting? Have invested in this particular instrument. Consider 4-year debenture. 4 years. How does the coupon pay? How is the coupon paid? Annually. 4 years annually. Each year you get one coupon. How much you are getting? We calculate the coupon based on the face value. Face value is 100. Par value is 100 in Sri Lanka bonds, Sri Lankan instrument. So the par value is 100 means what? Newly issued one. Means what? Now, if you go and see your bank debenture, they decided to issue today a fresh one. What do you mean by that? Fresh one. Not previously issued, ne? Calling issue issue. But when you talk about the treasury bonds, remember that we discussed the advertisement previously issued. Previously issued. Now this particular one, date of issue 2012 September. Again they are issuing now 2000 August, settlement 2021 September. total originally issued this date of issue, originally issued 2012 2021 then issue karna. There is a balance to be issued, then it is not a fresh issue, previously issued. So then meaning it can't be have par value 100. Remember, when you get a question or when you get a accrued interest with regard to treasury bond, meaning it has previously issued. Api you may bond not previously issued, new bond, fresh, not previously issued, then this particular bond has to be issued at 100. There can't be anything like accrued interest. There can't be anything like accrued interest. So another term. Now this was not discussed previously when we discussed this particular instrument. Now you can understand why this accrued interest part comes. Obviously it has previously issued. Balance part only now we are issuing. How make ඉස්සරහට issue ගන්න පුළුවන් ඇයි? මේකේ maturity එක 2023 2022 මේක issue ගන්න පුළුවන් balance එකක් තියෙනවා නේද? No issue. 1 year. 1 year treasury bond issue කරනවා. Of course, why not? Treasury bill name. It doesn't matter. 6 months? Possible. Now see. Now when is the maturity? 2023 September 1st. Now say 2023 March. Somebody was selling this. Somebody is intended to sell this particular one. I am willing to purchase treasury bond. But we have learned treasury bond is more than 2 years, more than 1 year. Now what is the remaining maturity? I'm going to purchase at 2023 March. What is the remaining maturity period? 6 months. But it's still a treasury bond. It doesn't matter. I told you, it has not necessarily be more than 1 year, but generally, if it is capital instrument, it has to be, but not necessary. September පළවෙනිදා සතියක් තිස්සේ මට මෙයා විකුණනවා. 1 week. 1 week වලින් we have not treasury bill of 3 months minimum. 6 months 1 week. So the 1 week instrument, treasury bond. Can. Don't worry about it, right? No, not necessarily not. But it can. It has to be. Generally we discuss the features, yes, more than 1 year. Why up to 1 year we have treasury bill? But it doesn't need to be, right? Remember that, right? When you're reaching the maturity period, it can like that, can be like that. Now see, when you see a question with accrued interest meaning previously issued, so basically your answer should not be have 100. It can't be 100. It can't be 100. Okay, it can't be 100. It can be either more than 100 or it can less than 100. So generally you should have accrued interest part here if it is previously issued one. If it is previously issued one, generally you should have accrued interest. Now somebody can ask this question, why this says ₹0? Why here the 3.93? Like that you should have a figure here. Why this 0? Now see the coupon payment. Now the issuing date, settlement date is September 1. September 1 is the issuing date. Settlement date. When is the coupon date? March 1st and September 1st. Another one you need to consider. Samanning settlement date and the coupon date, if it is same, then the accrued interest is 0. Don't worry about it. Very rare you get. Very rare. Right? Generally now in terms of treasury bonds, coupon interest rates are 15 and 1st. Generally can be changed. सामान्य जो है कूपन देखा ही पालन सह पालन सामान्य कूपन किए but this is very coincident, right? That's why it becomes 0. Don't worry about it. But generally you just speak about this. Generally you have only thing you have to keep in mind, if it is accrued interest amount is given, meaning previously issued. Otherwise, they don't give you. Now, see if you go and see your debenture, bank's debenture, it doesn't say accrued interest. Why? It's not previously issued. मैं आउटसाइड दमा issue करना. खाली 50,000 approval ला करा, 25 issue करला, इतने टिके टाइम issue करना, no. Debentures सा है मने. Issue करला, एक बार करा, finish. Now, treasury bonds are not like that. ආණ්ඩුවට සල්ලි හැමදාම වගේ issue කරනවා. So then blanket approval එකක් ඒගොල්ලෝ අරගෙන තියා ගන්නවා. මේ approval එකත් එක්ක යටතේ ඒගොල්ලෝ issue කරනවා this particular series. Right. Now coming back to this, and now see basically here we are finding out what is the pricing. What is the pricing? Based on the cash flows only we are generating. Now what are the cash flows we are getting by investing in this particular debenture? Only the coupon. Coupon interest එක විතරයි අපිට හම්බෙන්නේ මේක සල්ලි වලට. වෙන කිසි දෙයක් හම්බෙන්නේ නැහැ. What else? On the maturity, this is redeemable. It is not necessary to say. This is 4 years. After 4 years time, you are getting what? If you say investment amount, it's wrong. You are getting what? Face value. You are getting face value. You are getting face value. So I'll show it to you how do we do this, right? This is how we do this. Now, when you take this particular instrument to calculate how many cash inflows you are getting, 4 years, period 1, period 2, period 3, period 4. What do you mean by that? Four years. But I have not used the term years. You will realize why I am not using the years. Now here you can say it's years. Why 4 years? Remaining maturity period is 4 years. When we invest in this particular debenture, we are getting 4-year coupon interest. How come it's 4 years? Annually, coupon interest is paid. 16% gani given out. අවුරුදු 4. So how many cash flows I am receiving? 4 cash flows. 16 gani. So what is the fair value? I think you can see this, right? Fair value is we take it 100. Then what is the percentage of coupon interest? 16%. The answer should be 16. So every month, every year, I am getting 16 rupees. 16 rupees coupon interest. Every year, I am getting 16. Here, I am getting 16. Here I am getting 16. Here I am getting 16. Here I am getting 16. Correct? What is this? Coupon payment. What is this? Year of or the periods. Every year, the first period I am getting 16 coupon. 100 is the face value. Coupon interest is 16%. Each I am getting 16. This year, this particular period I am getting 16. This particular period I am getting 16. ඒ වගේ හතරක් මට හම්බ වෙනවා. What else? There is another cash flow I am receiving. On the maturity I am getting what? Face value. On the maturity I am getting what? Face value. This These are the cash flows I am getting. These are the cash flows I am getting. These are the cash flows I am getting. So each year, here the total is 16. Here the total is 16. Here the total is 16. Here 160. You got it? I'm not using Microsoft Excel since I just want to give you clear idea, clarity, right? And if it is a pure background, white background, you can see this, right? If I want to highlight this, okay. What are these? This coupon interest each year, coupon interest each year, coupon interest each year, coupon interest each year. Don't go wrong in the exam, whatever. 100 is also you are getting. What is this? This is face value. This is face value. Now, how do you interpret this? So you are the investor. You only calculate how much you have to pay. So how do you interpret as an investor? You as an investor here. අවුරුද්දක් අවසානයේ මට 16ක් හම්බ වෙනවා. දෙවෙනි අවුරුද්ද අවසානයේ මට 16ක් හම්බ වෙනවා තව. තුන්වෙනි අවුරුද්ද අවසානයේත් මට 16ක් හම්බ වෙනවා. හතරවෙනි අවුරුද්ද අවසානයේත් 16ක් හම්බ වෙනවා. So then if somebody asks me how much total amount you need to pay, can you add these four together and tell the answer is correct or wrong? It's wrong. Right? 16 ව 3යි 116 add කරලා if you say one answer, that is wrong. Why? The amount you are getting now is completely different the amount you are getting after 1 year's time. The completely different the amount you are getting, the same amount you are getting after 3 years' time. This 16 is not similar to the 16 you are getting here. Why? This receives after 1 year's time. This receives after 3 years' time. Is it similar or different? Different. Other රුපියල් 16න් ගන්න පුළුවන් නම් මට අවුරුදු 3කින් රුපියල් 16න් ගන්න පුළුවන්ද? No, you can't. Why? Inflation. So then what do? You bring all these cash flows. Now you know what is cash flows. Now these are cash flows. Now you know all these cash flows you should bring into today's concern. Today you have to bring it to today's now you should bring it to today's context. So year 0. How do you bring it today's how do you bring it today's context? You can't add this. So then what do? I know sometimes you must have learned this. The discounting. You have to discount it to today's term. Bring it to, so the අද හම් වෙන 16යි අවුරුදු 4කින් හම් වෙන 16යි two different. අද මට රුපියල් 16ක් හම්බුණා වගේ නෙමෙයි බඩුයක් ගන්න බෑ මට අවුරුදු 4කින් හම්බ වෙන රුපියල් 16. Obviously, right? Inflation. So then how do you decide? So you decide අවුරුදු 4කින් හම් වෙන 16 අදට මම කොහොමද you bring it to today's term. We are doing it. Now this is calculating the debenture calculation. Now this is where calculating the bond calculation. This is how the bond calculations are done. Even you key anything into the calculator, this is how you do this. Now how do you do this? What is your discounting factor? Discounting factor is what? It's given. Your required rate of return. How much? It's 20%. That's what 16%, 20%. 20%. 20% is a discounting factor. No, it is required. That is simple. Required rate of return, discounting factor. Expected return and the required rate of return is two different things. But don't worry about. But here, discounting factor. Now, we will be not learning here how to find the discounting factor, which is out of your syllabus. Otherwise, there are methods for you to find out discounting factor based on the dividend model and CAPM. You must have heard this. Capital asset pricing model. By using these, you can find out what is your discounting factor. But here, how to decide this 20? මේකේ දැම්මොත් මට 20 ඕනේ වෙන කොහේ හරි දැම්මොත් මට ඊට වඩා ගාණක් හම්බ වෙනවා එහෙනම් at least මට මේකේ 20 ඕනේ. You hypothetically think. Individual සාමාන්‍ය හිතන්නේ එහෙම. if දෙයක් දැම්මොත් මට හම්බ වෙනවා 18ක් මේකේ දැම්මොත් මට ඇත්තටම ඕනේ 20ක්. එහෙනම් 20කට හදන්න ඕනේ කියලා that's how you decide. It's a hypothetical question. Right? So then how do you do this? So how do you do this? So how do you discount it? So basically, how do you decide the discounting factor is this. Now, 1 divided by 1 plus R. You must have heard this to know this. Very simple enough. So the formula is 1 divided by 1 plus R to the power n. This is how you calculate. 1 divided by 1 plus R. R means discounting factor. 1.2. You know how did it come? R means what? 20. 20 divided by 100. 0.2. 0.2 plus 1. 1.2 to the power 1. That is how you do it. Now, this is cumbersome. What you can do is with your calculator, you can do it this easily. If you go this, whatever the calculator you have, 1 divided by 1.2. Answer is 0.0833. Take the 4 decimals. So the next one is what? 1 divided by 1.2 plus to the power 2. This is how we do this. Without doing this, it's an easy method is available for you to find out. How do you do this? Now, first one, how do you find out? 1 divided by 1.2. 1 divided by 1.2. I'm sorry, 1 divided by 1.2. 0.8333. Keeping that as on your display of your calculator, divide. Otherwise, you can 1 divided by 1.2 to the power 2, then 1 divided by 1.2 to the power 3, like that. Without doing this, easy method in the exam over here. Then you have the answer. This is the first year. This is the first year. You want to take this second year. Secondly, what do you do? This one, 1.0.8333 should be divided by 1.2. That is the easiest method you have. That's the easiest method you need to apply in the exam over here. divided by 1.2. It's 6944. 0.6944. And how do you find out the third one? Third one. This 0.6944 should be divided by 1.2. $5787. And the last one is we have 4.5787 should be divided by 1.2. The answer should be 1 divided by 1.2. 0.5787 divided by 1.2, 482. 482. So these are the answers I got, right? Just checking. Now these are the now see what does it mean? රුපියලක් අවුරුද්දක් අවසානයේ වටින්නේ 7.83333යි. රුපියලක් අවුරුදු 4ක් අවසානයේ වටින්නේ කීයද? 7.4.8යි 7.4යි 7.48යි. That's how you interpret. So the 1 rupee equals after 3 years time 0.7 cents 57. That's what it means. So after 2 years time 1 rupee worth only cents 69. Obviously, right? Due to the inflation. Basically, we are bringing here the inflation factor here. So then basically you can't add all these things together. So basically what you have to do is you have to discount it to this term. Now you have one particular platform now. So what do you do now? You understand how do we arrive this? Method is given. Straightforward method. Right? Discounting factor is 20%. Now you take this here. And you take this is the second period. And this is the third period. This is the fourth period. Right. Now what do? You multiply 16 into this. 16 into 0.8333. It's 13. 13.33. Then you multiply 16 into 0.6944. Answer is 11.11. So the third one you multiply 16 into 0.5787. That is 9.25. And you multiply 116 into 0.4822. That is 55.93. Now you add these things together. Now you are onto a common platform. Common platform. 5593 plus 9.25. 13.33 plus 11.11 plus 9.25 plus 55.93 plus. So the answer is what? How much? 89.62. What is this answer? Is for you to satisfy everything. Now understand. Now little cumbersome. For you to invest 4-year remaining maturity period of a debenture, which gives 16% annual coupon, plus which gives 20% return for your investment. So everything should be satisfied if you purchase this particular debenture, one unit at 89.62. So you pay 89.62, then everything will be satisfied. Somebody asked, what is your return on investment? It's 20%. So this is the bond pricing. This is the pricing. This is the intrinsic price you need to pay to satisfy all these criteria. Understand this? Now, what is this price? This is below 100, meaning this particular instrument is trading at discount. What is this price? This price is what? This price is, we call this price, dirty price. What do you mean by dirty price? The price we calculate for the bonds, the answer we are getting is dirty price. So the dirty price is what? Clean price plus accrued interest. You got it? Now you know dirty price. The answer we are getting by calculating the treasury bond is getting, the answer is dirty price. Dirty price comprises clean price and the accrued interest. So the accrued interest we know for the dirty price is the basically answer. Now in the exam, wherever you are asked to calculate the clean price straight away, you can't do that. Only thing, first you have to calculate dirty price, then you have to find, you have to deduct accrued interest. But I'll show you how to find the accrued interest, then only you derive clean price. What I want to tell you is, this is the bond pricing. Now imagine, this is manually calculated. Imagine 10-year bond. We have 2030 year bond. From today, 2030 again, how many years? Can you calculate the pricing manually? So how many periods? It's amazing. You can't do that. It's very cumbersome. So that's why you have been given the calculator. The calculator has been invented for you to calculate. It's very cumbersome. But even the calculator gives the price based on this only. Yeah? Sometimes සමහර වෙලාවට අපි දැන් කම්පියුටරෙන් දෙන ආන්සරේ somebody කම්පියුටරේ කොහොමද ආන්සර් එකක් දෙනවා. But somebody comes and asks you how this answer comes, what is the base, you teach me, tell me, but sometimes you don't know. But here, this is the base. This is the logic. This is the base actually given. Right, understood? Very clear. 89. So the interpretation, this is dirty price, and this bond is, this debenture is trading at a discount. Why? Today you invest 98. End of the period, how much you are getting? 100. So what's the difference? Capital gain. Plus you are getting every year 60. You got it? So the investment amount is this. But at the end of the period, how much you are getting? 100. Same or different? Make this year when a full or make a when it's 100 anyway. Make a see when a full or the full. If it's a new issue, this has to be 100, not previously issued. Forget about that. That is hypothetically seen. Today you spend 98, but after 4 years you are getting 100. So that's all. So the face value and the investment amount is two different mechanisms. two different concepts. Value can be changed, value can be similar, but two concepts that I want to tell you. Plus, remember, we have got everything into now this. After 1 year, this 16 rupees worth only 13 after 1 year. This 16 worth only 11 rupees after 2 years. This 116 rupees worth only 55 rupees after 4 years. Discounting. Present value. Remember, any exam now, if you have done chartered SIMA, then you have been given this formula sheet. But in the IVSL exam, this formula sheet is not given. This present value calculation sheet is not given. You have to keep in mind in the exam, right, how to do this. But this is the easiest method for you to do this. Keeping the first answer on the display, divide by this, divided by this. Answer should be divided by this. Answer should be divided by this. Right? Now, yeah, any question anybody has?
Yeah, sorry for the disturbance. So, according to this, the formula, discounting factor, what is the meaning of n? What we calculating on all these figures, the meaning of n, 1 divided by 1 plus r into n.
N means to the power n, that is the number of periods. Now 1 divided by 1 plus r to the power n. It has to be actually this number of years, number of periods to the power. It has to be power, right?
Is that so? So after second and third one, so we need to multiple in the number of years?
No. Basically, what you can do is, now this is the method I have for your convenience only. I have given this, but actually you should do this. This is how you do this. Now, first one it comes here. If you want to apply to the formula, this is the first one. 1 divided by 1.2 to the power 1 here. 1 divided by 1 plus r to the power n. N කියන්නේ පළවෙනි එකට අපි ගන්න ඕනේ 1. So how do you find out the second period? For the second period, calculate 1 divided by 1.2 to the power 2. To the power, this has to be go to the power 2 to the power, right? So third period, if you are calculating if you are going to calculate this formula, this is little cumbersome for you in the exam. So if you take third period, 1 divided by 1.2 to the power 3. Rather than applying this, you can straight away you can do this, keeping this particular amount on your calculator. This is the one method. This is the another method. This is the easier method. So we are actually telling the students to apply this method. This is easier method. So the first 1 divided by 1.2, you get answer here. Keeping this as on your display of your calculator, divided by this divided by 1.2. Answer divided by 1.2. Answer divided by 1.2. That's all. Rather than you finding the to the power, cumbersome. This is easy method for you to calculate. So apply this. This is easier. So you won't waste much time. This is easier.
Clear.
Now understand. So interpretation is this. This is the dirty price. This bond is trading at discounted price, right? Each year you are getting 16. So the end of the 4-year period, you are getting face value as well. Now, there is a slight difference. Then you will be understanding. If you can understand this, you will understand once we do this question. You can clearly understand what this means. So, shall we attempt to this question? It's very difficult to do it online, right? But try to do it somehow. Now, see, read the second question. How much should an investor pay to buy 100? How much should an investor pay to buy 100? Coupon 18%, 2-year bond which pays interest semi-annually. if the investor required rate of return is 22%. Now, have you seen the difference from the first one to second one? Only the difference is what? Frequency of coupon. That's the only difference. Other features are similar. No difference. Feature-wise, other features are similar. Only the frequency of payment of coupon is different. The first question we paid coupon annually, and the second one we are paying coupon semi-annually. Now understand the difference between these two. Now, how much cash flows, how much coupon you are getting during this 2-year period? How much coupon interest you are getting during this 2-year period? Can anybody say?
Four.
Yeah, very good. Why? 2 years. Remaining maturity is 2 years. Each year we are getting how many coupons? 2. Why? Every 6 months you are getting 1 coupon. For the 2 year, then ekavudra dekai, so the 4. Then the period is 4. That's what I want to tell you. Cash flows, we are getting 4 number of cash flows. 4 coupon interest we are getting. Why? How come it's 4? Semi-annual, 2 years. Avurudara semi-annual dekai, avurudekata 4. Then how many periods? 4 periods. Now remember. Now look at this. Right? So the same period by 4. So the basically first thing you have to identify, how do you take the decision of number of periods is based on what? Frequency of coupon. Now, if you say this particular question, second one, coupon 18% 2-year bond which pays interest quarterly. So how many periods you have to take? 1, 2, 3, how many periods you have to take? So the quarterly, how many quarters per year? 4. 3 months quarter 4. So the avurudekata 8. So then how many periods? 1, 2, 3, 4, 5, 6, 7, 8. If you say this particular question, interest is paid monthly, avurudara mas 12. So that 2 years. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 24. See the amount of difficulty you are facing when you have more coupon interest payment frequency. So that's why wherever you do exams, you don't get more than 2 years. It's very difficult. But I have seen one question in the DBF exam. I based it was given 5 years. I think it's very. So the semi-annual 5 years, 10 coupons, 10 periods, right? 5 year, 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So manually you have to calculate 10 periods, which is more difficult. It's like in exam. Right? Now in this case, semi-annual, every year you have 2 coupons. Here the remaining maturity period is 2 years. So then the number of coupons we have 4, then the period is also we have 4. That's how you do 4. 1, 2, 3, 4. So how much you are getting first period? So I'm not referring to year. I'm not referring to year. I'm not referring to year. I'm not referring to year now. I'm now referring to the period. The first period, how much you are getting? The first period, how much you are getting? The interest, the coupon interest. Coupon interest is anyway based on what? 100. Why? 100. Why? Face value is 100 anyway. Into coupon is how much? According to the exam question, coupon is 18% coupon. Here 18%. Now understand the difference, right? I'm sorry, 18% coupon. So then you have 18 rupees. This 18 rupees is annual or semi-annual? Annual. But here we are taking semi-annual, semi-annual, semi-annual. एक नंबर में मास आएगा हमें period. So then out of the dharna you should take it here how much? It should be 9. It should be 9. Every 6 months I am getting 9. Why semi-annual? These are the cash flows I am getting. Plus, on the maturity I am getting face value as well, 100. I am getting 100. I'm getting 100. These are the only cash flows I am getting. Discounting factor given required rate of return 22%. 22%. Earlier it was 20, now it's 22. Remember, the early equation we have taken 20%. Why? Here we have taken 20. Here we have taken annual coupon. Here the semi-annual coupon. That's why we have taken 9 each. Now here the discounting factor is 22. That is annual. Here don't make annual. If it is semi-annual, how much? How much? If it is semi-annual, it has to be 11%. So basically, your calculation should be discounted factor should be based on 11%. If it is monthly, you take monthly portion. Monthly means how many months? Then each month how much you are getting? And discounting factor also should be monthly. 12 by 2 monthly. Understood? This base also should be applied to here as well. That's the pattern. So the base should be similar. Make a semi-annual, make annual, it's wrong. Right? So basically you have to take it 11% as the maturity one. So how come it comes here? So the one. So 11 divided by 100 plus 1, 1.11. Understood? How come this comes? 11%, 11 divided by 100 can make a take it no plus 1. Then you get 1.11. That's how you get 1 divided by 1.11. So then what do you do? Similarly, same thing you apply here. 1 divided by 1.11. Here the answer should be divided by 1 here. Easy method, right? It's 1 divided by, I'll take it 102, 1 divided by 1.11, then 900, 909. You have to take here. Okay, here. Then here the answer should be, this answer should be divided by 1.11 means sorry, 909 divided by 1.11, that is 8116, and this you take into here and has to be divided by 1.11 divided by 1.11. So answer should be 73.7311, and you take here, so then the answer should be 1 divided by 1.11, 65.65. This is how you do this. Right? Then you multiply this. You take everything here, then you can multiply and you can get the answer. So I'll be not taking that here. You then multiply, right? So that is how. Then you multiply this, then you get an answer, right? Then you get an answer. So that's the answer. Now understand the difference between, right? To understand the difference between how do you decide the number of coupon, number of periods based on the frequency of coupon, based on the frequency of coupon payment, right? You got it? Any clarification you need on this? This is very important, right? Whatever. This is how you calculate the treasury bond pricing. This is how you calculate the treasury bond pricing. This is important, right? Now, any question you have? Understood, right? Right. Now, I want to tell you one special thing before we wind up this discussion. Now, I'll erase this one, right? And then watch it. Now, see, there is a instrument like this. Now, say coupon is 10%. This is the final one on this, right? Coupon is 10%. Coupon is 10%. Maturity is 2 years. RS. Just 2 years. Now, whatever the now say okay 20% collective, now 15% yield collective. Coupon. This is the maturity period. This is yield. Now that's a bond like this. Now understand this, right? That's a bond like this. 10% coupon, 2 years maturity, remaining maturity, 15% yield, and 2 year. Now this particular bond is going to be matured. Which කියමු April කියලා AP අපි ගමු different May 1 May 15. When's the maturity date? 2 years from today. Alright. So then we are going to we are going to purchase this particular bond tomorrow, Monday. It's 27. This is what we know that now, settlement date. This is settlement date. This is settlement date. Tomorrow. Settlement date is what? Now somebody was holding this particular bond. Now you are holding. Now you were holding this particular bond. I am going to purchase this particular bond tomorrow. I am going to purchase this particular bond tomorrow. Right? Listen carefully. I am going to purchase this particular bond tomorrow from you. From you. September 27. You were holding this particular bond. When was the last coupon received by you? When was the last coupon received by you? Why you are holding this bond? This is me. I am going to purchase this bond tomorrow. My question is, when was the last coupon received by you?
May 2021.
We'll see. Now, what are the two coupon dates? How do you find out? If you have not given the maturity period, sometimes you might have been given, ISIN number. By looking at the ISIN number, you should be able to understand, you should be able to find out the maturity date. One thing. Now, here the maturity date is given. So, what are the two coupon dates? We discussed. One coupon is due on the maturity date. Obviously, May 15, you are getting one coupon. May 15, you are getting one coupon. What is the other coupon date? This is a treasury bond. 6 months. When is the next coupon? 6 months. Pahanam, obviously, then what is the next one? 11. We have month of 5 may again January, March, April, May again Pasani Masan, Masa Hagra Paskan 11. So then 11 means August. You got it? August 15, the second coupon. Got it? Second coupon. This is how you get coupon for 2 years. Coupon for 2 years. This is second coupon. This is second. On the maturity, you are getting one coupon. Why? This is the maturity date, right? This is the coupon. This is the maturity. One coupon is due on the payment on the maturity, obviously we know. And the second one is after 6 months time or before 6 months time, whatever. අවුරුද්දට තියෙන්නේ May 1යි මාස 6 කියලා කියන්නේ obviously August. So August and May is the two different. Only thing what I want to emphasize you is be able to understand, be able to identify or find the two maturity dates. Right? So given the maturity date, you should be able to do this. Now, why? Then you don't know this. Last maturity you are getting one, after 6 months or before 6 months you are getting one. Correct. So, now I am going to purchase this particular one tomorrow. So my question was, when was the last you have received this particular bond? You were holding this bond. Wage account ekata me coupon එක Central Bank has credited. When was the last you must have received? Obviously, you must have received 2021 August. 2021 August 15. 10% coupon calculated based on the face value has been credited to your personal account. By whom? Central Bank of Sri Lanka. Last coupon you have received August 15. We are at September. September to first langam තියෙන obviously August. May dinithat එහා. You got it right? Last coupon was say August.
Excuse me, sir. Isn't it November? The 11th month, right? Isn't it November?
I'm sorry. I'm sorry. It's November. I'm sorry. Yeah. That's correct. Yes. Yeah. November. I apply November. I'm sorry. So when was the last coupon date you must have received then? Today we are in September. When was the last? Your answer was correct. So we must have received the last coupon. We are in September. Must have received May 15. The last coupon we must have received May 15. On the 15th of May 2021, your account has been credited by the Central Bank of Sri Lanka with the bond interest 10%, calculated based on the face value. Half year must have credited. Perfectly ordered. From May you are holding this particular bond. May 15 I got one coupon. From May now I am holding May, June, July, August, September, October. May, June, July, August, September. I'm holding now. September. I know today is September 26th. November, I'm receiving another coupon. I'm waiting for that. November. Now somebody comes and asks you, it's me, I'm coming to you. I'm asking you, I would like to purchase your bond. Would you like to sell this particular bond? Again, I'm asking a question. Same question. ඔයා මේ බොන්ඩ් එක විකුණන්න කැමති. But මේ බොන්ඩ් එක විකුණනවා profit එක නම් obviously you should sell this particular bond at below the purchase yield. This is something else, right? මේකට අදාළ නැහැ, but I'm just referring, I'm again refreshing you. Anything you want to sell below the purchase yield, then only you make profit. Okay? That's you know. For me bond එක විකුණන්න කැමති. I'm going to buy this particular bond. It's me. Tomorrow I'm going to buy this particular bond. You are willing to sell this particular bond. Tomorrow we are concluding the transaction. Finish. Agreed price. I am purchasing. You are selling. Finish. Now from tomorrow onwards, I am holding this particular bond. I am holding this particular bond from tomorrow. Fine. September 27, 28, October comes, fine. November comes, good. November 14 comes. So I check my details. Okay, there is a coupon to be received for me. Why I am holding this particular bond now? I have purchased from you. So the November coupon should be received to me. I have given my account details to central bank at the time of I'm purchasing from you. November 15 comes 2021. I should receive coupon. What does the central bank do? Central bank is doing, they calculate the 6-month coupon based on the face value and they credit it to my account, which is correct. Why? I am holding this particular bond. I have purchased it from 27 September. Now November 15, one coupon should be received. My account has been credited today. 6-month coupon. 6-month coupon. 6-month coupon. Correct or wrong? Ethical or not ethical? Now say today you invest your money. Today you invest money. The return you should receive from today onwards or from previous day onwards. If you make the investment today, you should receive the return on your investment should be received from today onwards. On 15 November, are you holding this particular bond 6 months? No. But how much central bank has credited to your account? 6 months coupon. Correct or wrong? It's wrong. Not ethical. It's not ethical. Why? I am holding this particular bond 27 September only. Sorry. I am holding this particular bond from September 27th only. So whatever the amount I should receive, whatever the amount my account should be credited, coupon interest should be calculated, the number of days should be calculated from 27th September to November 15. You were holding this particular bond from May 15 to September 27. Entire May, June, July, August, September, October, June, July, August, September. All these 4 months, you were holding this particular bond. Your money was invested. But what does the central bank? Central bank has credited 6-month coupon to my account. Who is happy? I'm happy. Why? This particular amount was with me. I have not invested in your bond. You only made the investment. You should receive this whatever the 4-month period coupon interest to you. But what does the central bank? They have created, which is wrong. But that's what the system works. That's how the system works. That's how the system works. Central bank is not worrying about you were holding 4 months. I am holding 1.5 months. They are not worrying about. They check the holder list on the particular date. They create entire 6-month coupon. Finish. You whatever negotiate with the buyer and seller. You decide whatever amount you need and you want to say you want to deduct whatever you decide. Don't bring it to me. Who says? Central bank says. I don't mind who was holding this particular bond. He checks the holder list. My name was appearing. Credited to my account. Entire 6 months. Finish. So do you think that will I give it to you back? I will not. මගේ account සාමාන්‍යයෙන් බැංකුවක account එකට වැරදිලා කෙනෙක් මොනවා හරි credit කරපුවාම it's very difficult to take it. Very difficult. Sometimes we must have withdrawn by the time we identified the error. Very difficult to. That's the normal thing. So basically, that's the human nature. So I will be not giving you back. How do you prove it? I don't mind. That is a mistake done by the central bank. You ask from the central bank. So to avoid this. So now understand, you got it right? From May 15 to 27 September, from here, from 2021 May 15 to from here to from here you should receive the coupon. You calculate number of days, May 15 exactly number of days you calculate it. May 15 is this is how you calculate. May 15 May again is a guy. So then how many days? 15 days. Then you have June 30 days. July you have 31 days. August you have 30 days, 31 days. September you have here 26 days. All these number of days you add together 15 plus 30 plus 31 plus 31 plus 26 plus. All this number of days, if you calculate it, so the coupon interest should be received to you only. How many days? 45 plus 62 plus 26. So the 133 days interest. Base interest should be received to you only. The central bank has credited this portion to me as well, to my account, which is wrong. Which is not ethical. So now 133 days, right? Okay. Now coupon interest. How do you calculate the coupon interest? 100 into what is the coupon rate? 10% here. Here the 10%. Here the 10%. Here 10%. And into number of days 133 days divided by 365. Remember why I have not taken 364? This is not a treasury bill. I told you treasury bill only you should divide by 364. Treasury bond actual to actual. May avurudhu ivaru 360 you should divide it by 366. If this year finishes, if you have February 29, then you should divide by 366. Otherwise, you should divide by 365, not 364. Actual to actual. If you calculate this, calculate this. 100 into 10% into 133 divided by 365, 3.64, 3.64. What is this? This is we call accrued interest. This is we call accrued interest. This is we call accrued interest. What do you mean by accrued interest then? Which is not entitled to you. Who is you? The new purchaser. So then what happened? Now see, now my problem has not been solved. So I should receive it. Now I should pay it to you. Now remember, when you calculate the bond pricing, we get dirty price. Dirty price is what? Dirty price is what? Clean price plus accrued interest. This part is belongs to whom? buyer, I'm sorry, this part belongs to whom? Seller. When I decide the bond pricing, which includes accrued interest part. So what does I do? As I am the buyer, I am including that accrued interest part in the pricing. So later I am not paying anything once I get it into my account. So කොහොමද මේ සාධාරණ ඉෂ්ට කරන්නේ? When I purchase this particular bond, accrued interest part which is not relevant to, which is not entitled to the buyer, මට මේක අයිති නැහැ. නමුත් මේ amount එක මොකද කරන්නේ? සෙන්ට්‍රල් බැංක් එකේ මගේ account එකට credit කරනවා මේ question එක විතර නොවැම්බර් 15. මට මේක අයිති නැහැ. So I have to give it to you. I have to give it to the seller. I'm not giving. But this part includes where? When you calculate the pricing. Either with the price, I am paying this part as well to the seller. Perfectly all right. This is how the system works. So when you calculate the bond pricing, it comes intrinsic value, meaning the dirty price. Dirty price means clean price plus accrued interest. Dirty price plus accrued interest. So basically, so understand, so the entire coupon interest is credited to my account in the sense the new buyer's, new purchaser's account, which is, there is a part which is not relevant to me, but don't worry, when you calculate the bond pricing, the accrued interest part which is not relevant to the new buyer is also embedded in that pricing. So that everything is perfectly all right, everybody is happy. Right? Everybody is happy. So when you calculate in this particular, now I have given some treasury bond advertisement, you can calculate the same thing. You have 100, which is the face value, and you have the coupon here, and from the last coupon date, now see, this is the new settlement date, new purchase date. Somebody was purchasing this particular bond on this date. They have to decide when was the last coupon date. What are the two coupon dates in this particular advertisement? March, September. What is the last? Now here you can't, you are actually confusing. Don't take this one. Here the zero, you take this one. The settlement date is 1st September. Somebody is going to purchase. When was the last coupon date? What are the two coupon dates here? 15th of April, 15th October. When was the last coupon? September, April, October. April. So from April 15 to 1st of September, otherwise 29th of or the 30th of August, 31st of August, you calculate how many days, then you get this particular answer. Antima decimal දෙකතුන වෙනස් වෙයි, right? Accurately you have to calculate. So antima decimal එක දෙක වෙනස් වෙයි, otherwise so the 3.93 should come. To calculate from 15th last coupon day, from the last coupon date to the settlement date. Last coupon date 15th April to 15 April to 31st of August. So divided by 365, 100 into here the 10.35 coupon. Same thing, you get this answer. Last digit එක වෙනස් වෙනවා. Last digit එක දෙක වෙනස් වෙනවා. So that's how you do this. Understood? That's how it goes, right? Now, so that's it. Then that is the discussion on that. So we have calculated that. You can read it. Don't worry about this formula, no worries. And this is, I have calculated another example for you. Now we have been discussing zero coupon bond. Zero coupon bond we have discussed treasury bill, but sometimes you might get a question like this: zero coupon but more than 1 year. This is how we do this. And this is straightforward the calculation. This we have discussed. This is also we discussed. Chapter M. Remember that we have discussed this systematic and systematic. This is the now see dividend valuation model. So I'm not taking much time on you. This is how you decide the required rate of return. There are two methods: CAPM and capitalized pricing model and dividend model.
Excuse me, sir, one small thing I want to ask from the
Yeah.
previous question.
Yeah.
This accrued interest part, from a seller's point of view, is he going to add this accrued interest when he pricing the bond at the time of selling?
Yes.
That's what
Now,
you meant, no?
no, yeah, true. What you're saying was absolutely correct, but he intentionally does not need to add. When you calculate the bond pricing, the answer you get is dirty price. Now, the answer we got, remember that the previous question 89 or something, which is included this accrued interest part as well. No need to again add it. So that's why we call this particular answer is intrinsic value, the true value. There is no difference. It's a true value. So this is dirty price. No need to add again. The answer you are getting by calculating the bond pricing is the dirty price. So in the exam, wherever you get, but in the bond calculator you can separately get it. Plain price and dirty price accrued interest, that is forget about that one. But in this question, the answer you get is dirty price, which is including accrued interest part. You don't want to add it again. But in the exam, if the examiner asks you separately what is your accrued interest, then only you have to calculate. Then you have to calculate separately, which is part and parcel of the answer. You got it?
Yes, sir. Thank you. I got it.
Right. Now, finally, we have done this. Now, this I think I have done with you the systematic risk and unsystematic risk. Finally, I won't take much time with you. Only five minutes. Now we discussed the required rate of return, right? Remember? So if I am individual, how do you decide I need this much of return on investment from this particular investment? Just comparing other investments. But if you take company, now how does the company decide their required rate of return? There is a method of calculating. You must have heard this cost of capital, but here we are not discussing that. Based on the cost of capital, they can calculate. That is the cost of capital. Now, if you are working in a bank, the bank is calculating cost of funds, right? The rupee cost of funds, deposit and debentures, and you add administrative cost as well. So anything you want to lend should be above this cost of fund. But for the prime customer, you are lending below that as well. That's a different issue. But definitely, if you want to cover the cost, you have to lend above cost of funds. But remember, individually, we are not calculating like that. We are actually comparing other alternative investment. Mata make it here, visa compare mata make it here the higher point like that. So hypothetically, you think that's how the questions are based on. Now, systematic risk is, I think I discussed with you. Systematic risk cannot be avoided. Systematic risk is common to everybody. Interest rate, inflation, common to everybody. But systematic risk cannot be avoided. Why? It's common to everybody. Unsystematic risk can be avoided by diversification. So when you discuss the shares, we discuss don't put all these into one basket. Of course, you don't invest in hotel shares. If you have done this, finish. Don't put everything into diversified sector. Don't do. If something goes wrong, there should be a way out. So then 10% here, so we will be discussing more on portfolio management. 10% here, 10% governmental, 10% shares, 20% land, like you distribute. So by diversification, you can avoid the unsystematic risk. Systematic risk you can't avoid. So when you calculate the pricing, when you calculate the yield, you have to add something for the risk which you cannot avoid it, which is unsystematic risk. So the CAPM is capital asset pricing model. This is the formula for you. Capital asset pricing model. Risk-free rate plus beta. Beta is the measurement of unsystematic risk. Only for the only you just keep in mind beta is the measurement of unsystematic risk. RM means return on market return. Return on market return, then again minus risk-free rate. The answer you get is the capital asset pricing model. This is your required rate of return. This is your required rate of return. Beta is calculated for you. If you are given a question, beta is given to you. So the beta you can have 0, more than 1, less than 1, but here we are not going to discuss. So that is more relevant to shafts, beta. But just keep in mind, beta is given to you. Beta is the measurement of systematic risk. Understood? So the systematic risk cannot be avoided. Right? Cannot be avoided. Unsystematic risk, yes, you can avoid by through diversification. Diversification only you can avoid unsystematic risk. Now, the impact of unsystematic risk factors on a portfolio can be largely eliminated or diversified away. Creating a portfolio, you can have portfolio, different investment, different percentages. Then you can avoid this. Another method, just keep in mind dividend model. So the dividend models, D divided by D means dividend, P means pricing. So this is, if it is no growth, now you know every year company is paying more dividend. So there is a growth sometimes, there is no growth, sometimes it's constant. So there are two formulas. If it is no growth, straightforward. If it is growth, G is the growth. You can calculate, you can apply this, right? So I'll be not taking much time from you all. This is straightforward calculation just to apply. And now remember, I told you in the companies, you have two things: capital plus debt, capital plus borrowing. So you get funding from the capital. If you are not sufficient with the capital, then you borrow. You also borrow from the bank or wherever. So for the borrowing, you have a cost. So when you borrow something, you have a tax benefit. Why? Now understand this. Now when you make a payment for dividend, you make the payment of profit after tax. You make the payment profit after tax. So all these expenses have been deducted. All these expenses have been deducted when you arrive at profit after tax. Correct? Whatever the amount remaining, you pay dividend. For the ordinary shareholder, you pay dividend. But if you have borrowed from bank or somebody, when you have borrowing, you pay what? Interest expenses. You have interest expenses. You have to pay interest. When you make more interest, what will happen? Your profit is reduced. When your profit is reduced, the amount of taxation you have to pay is also getting reduced. So that's the concept here. When you have more borrowing, you have a tax benefit. When you have more borrowing, you have tax benefit. How? When you arrive at profit, you have to deduct tax. You have to deduct expenses. The interest expense is one of them. So you arrive profit figure after deducting the interest expense. So when you deduct more interest expenses, you have less profit, then you pay less taxes. So when you calculate the borrowing or the cost of borrowing, you have to adjust the tax as well. T is the tax adjustment. This is straightforward preferred, right? And finally, now we have discussed systematic risk and unsystematic risk. That is risk, and there is another risk also, business risk and financial risk. Now, financial risk is basically shown where in the balance sheet. Business risk is shown where income statement. Financial risk is what you must have heard this. How do you tell solvency? If you have more debt than the capital, what happens? Debt to equity ratio is quite high. So one day you will be in trouble. When you have more borrowings than the capital, one day you will be in trouble. So, but borrowing is good for company, right? So borrowing is good for the company. Why? Just while ago we learned there is a tax benefit for the borrowing. So then borrowing is good for the company. You have to spend borrowed fund as well, but there should be a limit. Don't do excessively, otherwise you will be in trouble. Right? Your net worth becomes minus. So don't do. When you have more borrowings, when you have to pay more taxes, then what will happen? Your profit reduce. When you have accumulated losses, finish. So you have to be very careful, right? So that is one. And business risk is basically reducing sales and expenses, operating expenses also going up. So basically, business risk is we can identify from income statement. So that's what there are two types of different types of risks. So only thing you have to keep in mind, business risk is basically shown in balance sheet. Business risk is basically shown in income statement. So avoid the business risk. What do? You have to reduce the expenses. You have to increase the sales, and don't do overselling as well. Overtrading, you must have overtrading. Overtrading is what? You are selling lot of credit selling. Sometimes you may not recover those selling. So then you have to provide what you call this provision for doubtful debts. Then you finish. And don't do that as well. So you have to control it, everything. Don't go too much excessively. So that is two types of another risk. All right. So any question you have? I have uploaded. I think they have uploaded this particular one. Next topic is derivative instruments. So then I'll be teaching with you all. Anybody has any question? Anybody has any question? We have completed your topics. Basically, I have another 2 sessions to complete with you all. I have taken much time to complete, so I wanted to give you more knowledge on this financial market. We have completed. Then we will be coming to foreign exchange from next week. Here also I have completed the properties and financial assets. Then I have to complete derivative instrument with you. Then I have another topic to complete portfolio and this mergers and acquisitions. So basically, a portfolio theory won't take much time. We will be not doing in depth. Then I can finish off the last day, mergers and acquisition and portfolio theory. So the next week I can finish off so the entire 4 hours. I can finish off this derivative instrument. So basically, before I start the derivative instrument, I will give you knowledge on foreign exchange transaction. Then latter part of for that we can discuss the derivative instrument. We can finish it off derivative instruments, right? So that's the plan. I have another 2 days. So the last day I'll be completing portfolio management and the mergers and acquisition part. So next week we'll be completing foreign exchange transaction, derivative transaction. Any question you have so far? I'm very sorry for the connection lost twice. Any question you have? If you don't have any questions, we can wind up the class. So then we will meet next week, right? Thank you very much for participation.